first of all, welcome and just thanks for taking the time to join us today. I know everybody's gotten to be quite acclimated to webinars at this point in time, and so we appreciate everybody's time. We've got more people still logging in, but if you miss any parts of this or need to drop off early, we will have it recorded, and we'll get that out to you guys here in the next 24 hours or so. But hope everyone is safe, healthy, enjoying good family time, making the most of this. I was trying to think as we were preparing for this of another technology out there like Zoom or WebEx that people knew existed that didn't really use it very much. And then in a 30 or 45 day span, everybody was an expert on all of a sudden. And I couldn't think of anything quite like it. So anyway, hope everybody's getting on okay and not having any technical difficulties here. And again, if you miss any of this, we will bring this to you in via replay here shortly. So, I think as you're making your choice of what webinars to attend, for those that are on this today, I think you're in for a real treat. These four investors that are with us on here right now are very seasoned operators. Collectively, these guys own more than 85 properties and more than 21,000 units in the market today. And that doesn't even count deals that they bought and sold in the past. And another thing that's really interesting about these guys specifically is they are all owner operators. So in terms of pulling the strings on strategy and management decisions and all that, that's all done in house here. So they're not relying on a third party, and they are actively making those decisions. So, and then the last thing about these guys, and Paul can tell you more in a moment, but these guys were all buying deals before the last recession, made it through the last recession, and are here today. So that obviously is a great thing. So the purpose really of today's webinar, first and foremost, is just to provide everyone some kind of historical context of what happens in the multifamily world during this type of crisis. Obviously, this is an unprecedented situation that we're in, but nonetheless, the strategies and insights that these guys have and that they used in the last recession are still very relevant today. And I hope that will serve as a great encouragement as we deal with this in the coming weeks and months ahead. And I hope there's some actionable items that you're able to take away from this in the time period that's awaiting us here. So my partner, Bart Hoover, is on right now. He's going to be lurking quietly behind the scenes here, monitoring the questions that come in throughout this call. If you'll notice on the bottom of your screen, there are three little dots that you'll see. If you click on that, there is a Q&A feature that you can use, and you can make your list of questions for any of the panelists. Bart's going to be monitoring those, and at the end of the call, he's going to pop on and ask these guys some of those questions. Obviously, we're not going to be able to get to all of them, but we'll get to as many as we can. So Bart would normally tell you if he was unmuted that I talk too much, and I don't let him talk enough. So we're going to give his moment of glory here in the last 15 minutes of the call or so. So just a quick update on the status of our business right now, as I've spoken with many of you all over the last 30, 45 days. And that's a question that comes up right away. What's going on in y'all's world? I would say just a recap of the year so far. We had the best January, February, and early March of our career. We closed 17 deals, had a ton of momentum, and then obviously it all came to a screeching halt. There are very few deals moving forward right now with all the uncertainty out there, which is not really a surprise. Every variable that you have in a transaction, from payroll and insurance and taxes and other income and rental income and debt and equity, et cetera, they're all up in the air right now. So that is definitely a challenge, and we're doing the best we can to navigate that. I do expect as we get more clarity on those things moving forward, the markets will open up again. We have 4 deals in escrow right now. 2 of those I think will close relatively soon. One has been pushed out to the latter part of the year, and then the fourth one, we're trying to get that one to hold on, but that one may not make right now until the market gets better. So, and then one piece of really positive news is we are getting extremely close. We just got an LOI agreed to put a couple of deals in escrow by the end of this week. And so that is not easy to do right now. There's not many stabilized deals trading. I would say pretty much everything you see that is trading either was already in progress before this started or has some level of hardship to it, whether that's under capitalization, a loan maturing, partnership issues, et cetera. So, I think there's a lot of buyers who would like to do something before year end, but at the end of the day, we're most people are waiting to see how things, settle down and shake out over the coming 30, 60 days. So that's it in a nutshell on the brokerage side. I mean, but we're staying positive and we're working harder than we ever have been before. And we definitely feel like opportunities await in the future. So with that, let me turn it over to my friend, Paul Peebles. Paul, take it away.
Thanks, Nick. I appreciate that. I'm Paul Peebles, National Underwriter for Old Capital Lending. And today is all about learning from experienced apartment operators that have been doing this longer than some new apartment operators have been alive. So we wanted to talk about some of the veterans who have been in the business for over 25 years. Our youngest apartment operator has been doing this for almost 15 years. So let's meet your panel. So Mike Oxteen is with Price Realty in Dallas. He's a graduate of the Indiana University. He's been in apartments for the last 37 years, and he's purchased over 7,500 units. Eric Connor is with TriPro Management. A proud graduate of Texas A&M University, he has owned and managed apartments since 1995, and he's purchased over 10,000 doors. Charlie Young is with Madera Residential. He purchased his first apartment building from the RTC. If you remember that, it's the Resolution Trust Corporation that was around to clean up everything in the savings and loan problems back in the late 80s. So in 1991, he bought his first building from the RTC. So now almost 30 years later, he and his partners have purchased over 20,000 apartment units. Our youngest operator is JC Castillo. JC lives in San Jose, California, graduated from the University of Santa Barbara with a degree in engineering, and started buying multifamily real estate in 2006. He and his business partner, Eric Hardy, own over 1,000 doors, and he just closed on a 120-unit building just 2 weeks ago. So guys, thanks for being available and sharing your knowledge. And at the end, we're going to hear from James Eng with Old Capital. He's going to talk a little bit about the capital markets and what's going on there right now. So, and the folks in the audience, just like Nick had said, that if you do have a question, go to that Q&A button to write your question down, and then we'll get to as many questions at the end that Nick and Bard can ask. So now let's go. So let's start with the present, and this is really to all the guys in our platform here. I'd love to hear from you guys kind of individually about how were collections and leasing in April across your portfolio. So, Charlie, I'll let you go, and then let's go around the table.
Okay, so I got a wicked spreadsheet sitting in front of me. It looks like we're about 97% of collections for April for everything that was billed. And our portfolio spans from A assets down to C assets. And I think the disparity, it depends on the lower the grade of the property, the harder it was to collect the rents. Currently, an interesting stat for us is that our occupancies are up 1.4% for the month. We've got roughly 13,000 units, and we had 482 move-ins, 298 move-outs. All of the traffic, as everybody else, is online as a general rule. We had right at 7,000 leads, and that turned into 691 applications. So about 10% of what we had through online translated into an approved app.
Wow. Okay, let's go around. Mike Oxteen?
April is a good month for us. I mean, our property is similar to Charlie. We have several A's all the way down to some of the C assets. We collected about 96% of our previous month in March. Actually, I even have it better. So even our bill to what we collected was a little bit over 96%. Obviously, most of our leasing has been online. I don't have the particular move-ins, move-outs. The overall occupancy, we're in the three markets of Houston, Austin, and Dallas. I'd say overall, we're still 94%. Our weakest market has still and continues to be Houston.
And then Eric, how do you guys look right now?
Yeah, bifurcating that like Mike did. Our DFW portfolio, we're actually 98 to over 100% on compared to March collections. The over 100% is we set a series of move-ins, kind of speaking to Charlie's point. And our Gulf Coast piece of it is close to 91, 92. Those are recent purchases, so it's kind of tough to tell whether there was a COVID issue or just in general cleansing. But we've had actually a fairly strong leasing, much stronger leasing performance than expected.
And then JC, again, collections and leasing for April, how were they?
Yeah, collections for April, I would say that I've seen the same thing across the boards as the other folks here, the other operators. As of April 26th, when we pulled all of our data, we were 98% collected against billable rents. That's not counting other income or anything else like that. That's just billable rents. If we look at the trailing three average of January through March, we were about 99% on the same 26 data those months. So we really haven't seen much more than a 1% drop off. One thing that is interesting that we definitely saw was we've been tracking the collections to date pretty much every 5 days from April 1st on. And early on, we saw about a 4% drop off day for day, meaning that a lot more people were paying late or hadn't paid in the earlier part of April. But mostly all of the people that paid late were able to catch up for April. It'll be interesting to see what happens going into May and whether those people can catch up as we continue to go through this downturn.
And then Charlie had mentioned, breaking it down between A, B, C, and you guys don't go anything lower than that. And then Charlie, again, would you say A quality assets have the highest collections? And then what's your next percentage below that? Does it go down by, let's say 97, 98%? Does it go down to 90%? And then C's down to maybe 85? I mean, give me kind of a breakdown of quality of the asset itself.
It's not an exact science, but the trend is that the A assets or the nicer B assets are the ones that collected better. We've got 4 assets, I think it is, that are below 90%, and they all would be C assets in tougher areas. Then everything else just kind of flows in between.
And you guys just went under contract on a deal in Houston. First of all, are you crazy? Have you looked at oil prices these days? What's the reasoning behind buying a nice property down in Houston?
So I would say that if somebody's going to buy a deal today in the next 90 to 120 days, it needs to be at a sizable discount. And so, right before COVID, we had 4 deals that we were about to put under contract. And fortunately, on Monday, the 15th or 16th of March, when that hit, we had not gone under contract on those. And so we just told the sellers we were going to be on pause. 3 of them were in Houston. And, I think Nick alluded to it earlier, a stabilized deal you're probably not going to do today. The deal in Houston is not a stabilized deal. It's a 2017 vintage that is, it's got some distress on it, and we're going to buy it at probably 25% discount to where it should be. So I'd say, no, we're not crazy. We're just planning for the long term.
That's great. Let's go back to collections, and let's talk a little bit about what you guys are anticipating for May in light of the successful leasing of April, the stimulus money, the enhanced unemployment numbers, tax refunds. Let's kind of go around the table one more time and kind of talk a little bit about what do you think for May and possibly going into June?
Well, I can start it off. This is JC. I think that a lot of people are saying that they don't know how collections are going to go in May. And I have to agree that there's a lot of uncertainty. But one thing that we did do with our portfolio is we got pretty aggressive early on with communication with the residents. And we've been really pounding the phones to track every single person that's had job loss or hours cut at the portfolio. And so what I can tell you right now is that we're sitting at about an average of 6% of the total resident base at our properties that have indicated job loss or job hours cut. So if we just forward to May and we say we've got 6% of the resident base that is affected by COVID, then, I don't see a catastrophic May. Instead, I see, maybe a 5 to 10% drop off at the worst. And that's what I would forecast based on what I've seen. And again, our portfolio is 100% based in Dallas-Fort Worth.
Mike, how are you guys looking for collections or estimates for collections and going into May?
Well, I would agree with what JC had to say. I mean, we don't know. We have done a lot of communication, an early bird drawing, to qualify for 2 weeks off your month, for your next month by getting it in. I do not see a catastrophic May. I think it'll be slightly less than April. So we probably should do this call in 30 days and really see where the proof of the pudding is. Actually, and I've been beating up on Houston, but we had some of our better leasing actually in Houston. I don't know why, but it's actually a couple of properties where, their collections were a little bit better than budget. So I really don't know what May's going to bring us, but I would expect, it should be 90% or better.
Eric, what do you think about you?
Yeah, I agree with those two guys. The only additional points I'd make is I do believe that net traffic, more traffic being move-ins versus move-outs, is going to decrease. I think there was a spillover of those who had 60-day notices, 30-day notices that fulfilled those either on the move-in or the move-out side, and that kind of spurred a lot of April traffic. I think May overall traffic is going to be more stagnant. With that said, on the leasing side, at least we found through April that probably 70% of the units that we leased were the premium kind, put 6 or 7 a door into it. That was surprising. I thought there would be a reversion back to kind of the classic or base units. We did not see that.
Got it. Charlie, what do you think? May, good?
So the spreadsheet I'm speaking off of, my partner Dave Marcinkowski and his team put together. So I got to give them all the kudos for where we're at on our collections and on our leasing. And they have worked incredibly diligently, being ahead of the curve, talking to the residents. I would say our residents seem to be like what JC's talking about. There's a group that is impacted by COVID, and then there are a lot that are not. And I think that showed up in the numbers. So May is, we'll just have to get to it and see. I feel optimistic based on, we have a number of people that are moving in. Our occupancies are up. I don't know the exact number of the folks that are COVID impacted, but I don't think it's that great. I saw one question pop up earlier about rent strike movement. We have not seen any of that. All of ours are in Dallas, Fort Worth, or Houston. So that has not cropped up. I think it's been a great time to really, really work on your online presence. And Dave and his group have really worked diligently on that. And we feel very optimistic about it.
Cool. Nick?
You guys are all owner operators, meaning your own management company. So maybe share with the group a couple of best practices that have been effective for you over the last 30 or 45 days. Eric, why don't you start?
Yeah, I'm not sure there's anything innovative here, but we mid-March moved immediately to a split pay option, pay half on the 5th, half on the 20th, and broadcast that immediately. And the thinking there was obviously to give people some relief, and most people have half a month's rent, at least it's saving. So I think that contributed a lot, and we're continuing that in May, just to offer that split collection opportunity. And the second thing is we've also gone to split teams on our employees to kind of keep them safe and healthy. So we have a maintenance man and an office person in a locked office doing emergency work orders only, but we're splitting those teams up.
And what about renewals, Eric? What are you guys doing on renewals right now?
We've done 2 things. We're offering a 6-month renewal option at no increase, just to kind of keep people in place, and/or we're offering a year option in property specific. Depends on how aggressive we're being on those.
Okay. JC, how about you?
Yeah, I think it's a similar story here in terms of, the way we're looking at our portfolio right now in terms of we want to focus on keeping butts in the seats. We're probably sitting at about 94% average occupancy across the portfolio. And so sure, we want to scoop up some new leases if we can, but we're also more concerned with keeping the butts in the seats. So as Eric pointed out, we've got the same strategy in place. We're doing a 6-month lease where we sign the residents up at the current rate, even if it's below market. And we'll kind of worry about moving people up after we see the market get a little bit better.
This is the part of the conversation where I want to talk a little bit about history and been there, done that type of thinking. So this is for Mike Oxtein, who, him and I have been doing this for a long time. I've known Oxtein for a long time, but they're all experienced operators, and you guys had a front row seat to this thing for the Great Recession just about 10 years ago. Mike, how did that impact your portfolio at the time?
Well, if you're referring, like going back to 2008 when the first crisis hit us, is that what you're?
Yep.
It's just like what we're doing with our residents. It's just being open book, communicating. Even as an operator, just maintaining your assets, don't getting behind on deferred maintenance. So when things were difficult in 2008 and lenders did come and look at your assets, they've been well taken care of and well maintained, and they knew that, we didn't let anything get deferred. And we were very communicated with a majority of my portfolio, and even today it's still financed by Freddie Mac. And it's just tell them where we're at, what are the issues, and they knew that the properties were well taken care of.
Yeah, a lot of folks
that were today differently. I remember what got me in trouble back in the late 90s, when I started syndicating in the early 90s, was, and I didn't do it this go around, is put too much debt and didn't over lever any of these deals. In the beginning was to refinance, pay back the money, give back the money to the LPs where I would get my bigger GP share. I didn't, on some of the deals that we've done this year on the refinances, we only put 60 or 65% debt. So that was a difference from before and today, basically.
Your portfolio is about 65% encumbered right now?
Yeah, probably 60 to 65%.
But if you went back 10 years ago, and a lot of people were not in the business 10 years ago or even 7 years ago that had invested in apartments, what was some of the things, we've had the COVID-19, the coronavirus that's kind of collapsed this market a little bit or put a lot of fear into it. What were some of the things that were going on that period of time that was keeping you up at night?
Well, in 2008, I had 3 or 4 deals that the debt was due, and there wasn't any financing for them. And then, the B-piece owner, Lennar, had a lot of the paper, especially on the conduit side of the loans, and there wasn't any Fed bailout, there wasn't any forbearance agreements like Freddie Mac has come out and said, look, if you're getting issues today, we'll agree to do some sort of forbearance. Back then there wasn't any. It was like, it was hard to get the BP's buyer on the phone. It was hard to get them to negotiate. It was, they would send letters, your debt is due, et cetera. Today, Freddie Mac, the difference today is they're coming back and say, we know we got a problem. We're willing to work with you. On the same side, we don't want you to evict any of the residents for 120 days. So the lenders have been more corrupt. It seems like even though I didn't have any issues or any legacies or anything that went back, today the lenders are more out in front of it and willing to listen and work out the issues.
But some of the things that went on during that period of time, and a lot of people don't remember this, is that it was almost cheaper for the tenant to buy themselves a house than it was to rent during the subprime area. So that kept a lot of people up. And then when we did have the kind of the financial collapse, a lot of the people that were in home building, that were a lot of our tenants, decided to go back to Mexico or their home country. So we had a lot of vacancy on these properties. You didn't have any properties that went back, but did you have any problems with your personal balance sheet during that period of time?
Well, I mean, I've had one capital call in 30 years of doing this. So I had a lot of my lines hocked up to keep a couple of these deals going forward. And then, as I mentioned earlier when we were on the phone previously, they were paying $20,000 an acre for mineral rights in the Woodhaven area. So that was like a blessing from God. But no, I had no legacies. I did not go back to my partners for capital calls. I was able to, carry it out. And the other thing that we've always done, and I'm sure every one of you guys that are on this panel, is that you have adequate reserves for this rainy day. And it's the same thing that held true in 08 that holds true today, that got plenty of reserves if occupancy or rents, drop significantly this next quarter, that we're able to come on top when things do turn around.
Yeah. So, look, everybody on this panel has been in business for a good while, as we alluded to earlier. When you look back at the last recession, and Charlie, I'll direct this one to you. Why do you think others haven't been able to survive some of these previous downturns that we've gone through? And you guys have survived it and obviously continued to grow over the last 10 years.
I'm going to tag on to Mike's comment about the debt and how important that is. We got really lucky in 2008 on one property. And it's the only property we've ever had to have a capital call on. I remember going in to meet with limited partners. One of the guys was a really big oil guy. This was in Houston. And I told him what's going on. He goes, I understand a dry hole. He thought he had lost it all. And I said, no, sir, unless you stop drilling on it, it's not going to be a dry hole. We've never given a property back. But that really emphasized to me the importance of having margin in your deals, having the right debt. I think a lot of people found out in 2008 that they didn't have enough lifeline, enough runway on their debt, and they had too much. And building up to 2008, there are people that were getting 80 and 90%, even 100% of debt on their property. And that's just, and to go, okay, at the time you thought that was great, but in hindsight, it was crazy. The underwriting was really bad. Some of the lenders at the time were allowing this. That doesn't happen now. I mean, all of our stuff gets scrutinized. And so Mike is exactly right. You've got to have a manageable level of debt. Even if a lender tells you could have X amount, you may want to look at it and go, really, is that going to give me enough margin? And so I think the debt piece, having some margin and reserves and being realistic about what you're doing and your expectations going forward. One other real quick piece, if somebody's had been underwriting for a short period going into this COVID deal where they go, we're going to hold the deal for 3 or 4 years, and you get that far into the cycle and you're buying, then you're going to get into a place where you're going to get hit. You never see it coming, ever do you ever see it coming. And so if you get deep into a cycle and you're still planning on flipping assets, then odds are you're going to get caught, and that's where you're going to get hurt.
Yeah. Hey, Charlie, one question that just came in, which is a good one. What do you guys consider adequate reserves? In other words, you hear a lot of people that are in distress right now are the ones that just are underfunded. What do you guys, what's a general rule of thumb for you, that adequate reserves for a rainy day?
I think right now we have 70% debt on our properties, and we feel pretty good about that. And then we're keeping some reserves back in the accounts. And I can't give you a specific amount, but we've always got a little bit of cash on hand for events like this. And everybody knew it was coming. Nobody knew when. And all of a sudden it hits. And, now we get a reset. We get to start over, and the clock starts running again. And hopefully everybody learns a lesson from it. Yeah.
So JC, what in your mind, what are you seeing as the main differences between the last recession and this? And I guess what adjustments have you made to your business strategy as a result?
Yeah, I mean, I think if you look at the last recession, as Charlie and Michael pointed out, this was really more of a liquidity crisis that happened back then. The banks just stopped lending like that. I mean, they just turned it off. And if you had a loan that was coming up due, even if your property was cash flowing, you really didn't have any options to get it refinanced. The difference, what's happening now is a little bit different in the sense that, this is really more of a global crisis. And so, people are getting hit everywhere. There's really no difference between whether you're in the financial business or you're in the retail business. Everything is getting hammered. So how it relates back to multifamily, the biggest thing that I would say is that, if you're in multifamily right now and you've got a property, I mean, your biggest concern right now should be to make sure that you've got plenty of reserves in the tank, as these guys said, and that you can sort of make it through this next couple of months to maybe 6 to a year. It's hard to say, and then come out on the other side and kind of see what happens from there.
Do you have a rule of thumb for your stuff for how much reserves that you like to keep on hand?
Yeah, for every 100 units or so, we're trying to keep about $100,000 in reserves most of the time. And right now, we're trying to actually increase that by about 50 to 100%. So we want to have reserves for about 100 unit property of about 150 to 200 grand. And then anything above that, we'll go ahead and distribute out as distributions if we can keep making profit.
Okay. Yeah, that's interesting. So Eric, let me give you a question here, so that maybe talk about one lesson you learned from the last downturn that you've been able to take with you over these last years that's maybe now coming in handy.
Yeah, Nick, I don't think it's just the last downturn. If you look at after 2001, you look at after 2008, we've been in 4 hurricanes in 3 different cities. They all have the same set of commonality that operations matter. And I'm stating the obvious, but when you get these run-ups like you've had 03 to 07 and now, the difference between average management and great management is immaterial. So when it really matters is when you have these kind of crises, it's a matter of, not cutting the $60,000 manager down to a $40,000 manager, presuming the competency is different there. As Mike said, making the investments in the assets, because that's what matters. So it really does come down to operations in tough times. Not that we're any better than anybody else, but it matters. It really matters.
Yeah, no, that's great.
I was just going to say, President Trump had a book called The Art of the Deal. And now today it should really be the art of the management of the property, the art of really the operations of the deal itself. And that's really going to save people coming in and going out of this deal is operating the properties the most effectively instead of just trying to put these deals together. So question I have is either to maybe Mike or to Charlie, is that what have you seen of any good that's going to come out of this crisis? It's hard to think that way right now, but do you think there's some good pieces or items that are going to come out that you say from this last recession? Charlie?
The answer, yes, there will be good that comes out of it. It is very hard to see. I think the macro picture is going to get better for multifamily. I think one of the things that everybody is seeing now, that this is the most resilient piece of real estate that's out there. So I think there is going to be more interest in multifamily. I think as we come out of this for the next couple of years, there could be a lot of people that are very gun shy about buying a home, and the credit side of that could get tighter. And so that could give us a little bit of a boost. So on the bigger macro picture, I think long term, we're going to be in a better place. There's just piles of money that were stacked up before this to go into multifamily. And after we get to a point where we're back to stabilized, then that will be flowing back into multifamily. So multifamily is not going to go anywhere. I think the cap rates may go up a little bit for the time being, but then I think we're going to come back close to kind of where we were. Gives us an opportunity right now to possibly find a few deals.
So this is going to probably be for Mike. So, we've seen this real estate market literally seem unstoppable and suddenly do 180-degree turn overnight. And all of you guys went through the Great Recession in 2008 and have enjoyed the last, say, 10 years of prosperity. Now having experienced the latest downturn, does it cause you pause and reevaluate how you're doing deals? Or is this just mostly a temporary setback and a market correction? So let's start off with Eric. Eric, how about that? Have you put on pause, or are you looking to go forward during this period of time?
Oh, I think there's a temporary pause. Charlie's pointed out, unless it's a steal of a deal, it's a huge risk to take on a stabilized asset. But I think it's a temporary. Ultimately, over a medium term, 1 year, 18 months is a temporary correction. That I don't know if it'll revert back to kind of the historic levels we had before, but I do think debt markets will open up. You're obviously more qualified to talk about that than I am, but I think that there'll be some slight movements in cap rates. I think that C will stay roughly the same, and eventually we will get back to a kind of normalized pattern. I think midsummer it starts to open back up, but ultimately we're not in a buying mode right now unless it's just a real steal, so to speak.
Well, Eric, let me just add something to that. I think it was you that said yesterday when we were talking that initially you were planning on cutting back your renovations just during the middle of this, but you had some in progress and then you leased them all. And so, maybe touch on that, because I do think, I know there's been a couple of questions that have alluded to the value add strategy at this point in time. And I think most are feeling like, I'm going to pause that. And I'm not even sure that's a good strategy moving forward, but maybe touch on kind of the success you've had over the last 30 days with some of these upgraded units.
Right. So you're referring to the interior CapEx for the most part, but yes. So I mentioned earlier in the call that 70% of all the units we've leased have been the premium or the upgraded units, and we were ready to scrap that program for all the obvious reasons, and kind of kept it going. And we're monitoring that and trying to save money, but we're still find that if you have a long-term view, spending $6,000 a door to get a $150 rent bump makes all the economic sense in the world if you can plow through it. Now, you're kind of past that cycle in your capital stage where you don't have that. That's a different kind of decision. We already had these in escrow, either with a lender or internal, so it makes it a little bit more of an easier decision. But we are, I would say aggressively, but per previous plan, that is not altered. We have 2 deals that were in kind of major exterior rehabs. We've not altered those either because, again, the money is there and we feel like it's going to improve the asset and take care of deferred maintenance, and just costs us more money in the long run, to Mike's earlier point.
Yeah. That's great. Let's talk about just some different data points that you guys are tracking right now. JC, what's on your radar? What are you tracking? Are you tracking unemployment numbers? Are you tracking something more at the site level? What are the numbers that really have your attention at this moment in time?
Well, there's a couple of things I think that we're tracking. I mean, on the macro side, obviously I think we're all kind of tracking the economy and what unemployment looks like, and specifically how it breaks out to the different metros that we're operating in. But I think if we dive into the properties and the portfolio itself, I think, one thing that's obvious is we're really tracking the rental collections. I mean, do people have the ability to pay? Are they able to pay? What kind of concessions are we having to make to get them to pay? So that's the biggest thing that we're tracking. The other thing that we're tracking, and I'll kind of allude to what Eric was talking about, is we're tracking expenses in the sense that we've taken the opposite approach of sort of what Eric is doing in terms of we did decide to shut off any upgrade programs at our portfolio across the board. We did that as a temporary measure. We just didn't know in the very beginning how this was going to shake out, and we're still not exactly clear. So we just want to make sure that we've got an extra amount of money in the gas tank. So things like our upgrade budgets are being slashed pretty much to nothing right now. Our payroll, we had contractors that were helping us turn upgraded units to install everything from granite countertops, et cetera. We cut all the contractors out of our payroll, which reduced the payroll significantly at our properties. And then we've just got the employees that are on the regular payroll that are working there. So for us, we're tracking expenses big time in terms of where we can shave stuff down. And we're tracking income and seeing how much is coming into the front door.
That's great. So, as we alluded to it a little bit earlier, Eric touched on the value add stuff. I'm curious, Charlie, Mike, what do you anticipate in the coming months as it relates to kind of underwriting value add? I mean, are you going to continue to underwrite? I know obviously it's not going to be the same as it was 30, 45 days ago, but are those deals dead for the time being? And are we just going to be focused on sort of market rate deals at low bases, or what's your take on how that underwriting is going to shift? Charlie, why don't you start, and then Mike, you can chime in.
I think it kind of depends on how you're structured with your lender. Some of those loans have timelines for being able to get the work done. Madera is going to take a long-term perspective. So everything that we're underwriting today, we're underwriting for 7 years. I don't know that I have the time to wait to go deploy those funds. I know Dave and his operational team are working feverishly while it's a little bit quieter time on turning as many units as possible. So when the doors do finally open up for regular business, anybody that's looking for something, we're going to be ready for it. So we're not turning off anything that we've gotten down as a value add program. We're not going to change that. I will say underwriting today, I am probably looking out a year to 2 years and just putting flat rents in, and it may be negative, but for the long term, I don't think it's going to matter. And that's the way we're couching it for our limited partners. Started talking to them over a year ago about this period coming and being ready for the long term. And so that's how we've got it kind of set up to go.
Yeah. How about you, Mike?
So, Nick, our whole plan really is we're long-term holders. I mean, if you look at our portfolio, I mean, you look at Preston Spring Valley, hell, I've owned that since 2002. We're long-term holders. We always raise all our funds up front, what we're going to do to these assets, be it inside, outside. We're going to continue with our 2020 budget. If we're getting paid for the upgrades, we'll continue to do it. If we're not getting paid, obviously we'll back off. As far as future acquisitions, I got away from that upgrade buying frenzy. I started buying newer product like Standard City Line or some of the stuff I bought recently in Austin were 2016, 2017 built. Hopefully there'll be a silver lining and we can find some of those deals to buy. I think the next class would be maybe all the upgrades have been done and the seller needs to get out. We'll look at that. And obviously, if there's an opportunity on a value add, we've been doing value add since we've been doing this from the beginning. We'll buy those. I echo what Charlie and what everybody says. We don't know how to project rents going forward at this point, and rent growth probably will be flat. So everything depends on where your money's coming from. I'm fortunate that I have a lot of investors that like that quarterly distributions, that they're long-term holders. They like it when I refinance, give their money back, and turn around and go do it again. Then we got our institutional partners where they want the value add story, they want the high IRR returns, and they want to be in 3 to 5 years exits. And then, so, everything boils down to whose money, how long. But if you look at our portfolio today, a majority of it is long-term holds.
Yeah, no, that's great.
I'm going to throw it over to James. James, do you have a question?
Yeah, I mean, we work with a lot of syndicators, and what would be your advice for guys? Maybe they bought 1 to 5 properties in this last cycle, and number one, they have to survive this downturn. But then how do they ever get to the scale of you guys, right? So you guys own anywhere from 10 to 30 properties, 5,000 to 20,000 units. What advice would you have for those syndicators that, maybe they got 1 to 4 properties now? How do they ever get to your scale and stay around this business so long?
I'll take that one really quick. If you do the right thing, you will be amazed at how you can scale your business. It's a track record. And if you take the time and do the right things, one thing I always say, under promise, over deliver. Whenever you're talking to your limited partners, you do the best job you can at under promising where that asset's going to go, because something's going to come up like this, and you got to be ready for it. But just be diligent, be straightforward, and do good work. And if you're looking to scale up, it'll happen.
I'll add briefly to that. Charlie made a point about doing the right thing. I mean, like Mike, we've never made a capital call on our 57 deals. Doesn't mean we haven't infused capital. That came from us. We made that decision to do that. And Charlie's point, limited partners are sophisticated. They realize that, and that's one way to build long term.
We had some issues in Houston, and I cut my management fee to 0. So, and it goes back to what Charlie and Eric, you just got to do the right thing. Investors don't like capital calls. They don't like you getting paid management fees when you're not distributing any cash to them. So, you just got to do the straightforward, communicate, and be honest. And anybody who invests with you, they've all been through cycles. They're all businessmen, or businesswomen. They've all had issues with different times of their careers, and it's no different. We're, even though we're in multifamily and they own a steel mill or they're a beef producer, they all got similar issues. So as long as you're diligent and communicate and are straightforward, you should be able to grow your company.
I think I'll take a little bit of a different angle. I mean, I think these guys are right about doing the right thing. You absolutely have to do that. And sometimes most times, in fact, every time you got to put your investors ahead of yourself. But I think the other thing, if you look at this panel, we all have our own operations. So I'm going to really say that if you want to get out there and scale, I don't think that you have to necessarily open up your own management company. There's a lot of heavy lifting that goes on with it, but I do think that you have to be an expert in operations, even if that includes you having a third-party management strategy. I mean, if we look back at the last 6 or 7 years, a lot of the success for a lot of syndication companies was masked by, a rising tide floats all boats. I mean, when rents go up 5 to 6 to 7% year over year, I mean, it doesn't matter how bad of an operations you have, you're going to look like a genius. And I think that right now, what we're going to see happen is the people that have really put a lot of work into operations and into asset management, and they have spent a lot of time on that stuff and have a really great strategy. Those are going to be the people that really survive a downturn, because you have to fight for every single penny right now. And it wasn't like that 3 or 4 or 5 years ago. You just bought a deal, and 2 years later, you sold it and you doubled your investors' equity. That's just what happened. So for me, if you're out there and you want to scale, you really got to focus on operations right now.
All right, I got one more. We'll go around. So imagine I give you a broken deal, negative cash flow, 200 units in Dallas. I send you the deal and I say, how are you going to finance this deal? Let's go around the horn. How would you finance it right now? Charlie, I'll start with you.
It will depend on where it's at. It would depend on the
DFW 200 units.
What class?
B, Class B.
You're going to end up having to use some type of bank debt.
Bank debt recourse?
In Dallas, you can find some lenders that will not be recourse.
Okay, so non-recourse bridge, you're thinking?
You're not going to do an insurance. You're not going to do a debt fund. You're going to do a bank loan that's going to be very low leverage until you can stabilize it and then flip it into Fannie or Freddie.
Okay. Mike, how would you finance it?
I agree with Charlie. It's bank debt, or you could raise, bank debt is the best way to go. Non-recourse, recourse would be the best way to do it. And it's real important just to add is, really, if you want to, you got to get some banking relationships going. That's one thing that really helped me back in 2008, and I'll be quick. I have several banks here locally, and if you ever got an issue, some of these banks are not going to be around for you. I highly recommend that you get several local bank relationships. I think that's critical, and that also helped me survive 2008. But to answer your question, James.
I'll agree with that. I think you need to have 10 banking relationships.
JC or Eric, how would you guys finance it?
Bank debt, recourse. And James, could you call me afterwards directly on this deal?
No problem.
I'm going to go along with the other. Everybody else already said the right answer. And the only thing I'd say is I probably wouldn't mess with that deal to begin with right now.
So it's a little too early, you think, JC?
It's absolutely too early for that. Right now, if you can get a deal at a great basis like what Charlie's doing, then that's the right time to move right now. But other than that, I'm sitting tight. That's what we're doing.
All right, guys. Bard can't stand it anymore. He's turned his video on. He's ready to bring the questions that we've had. So, Bard, come on, give us something good.
All right, first question. So what is y'all's opinion on the open Texas order by Governor Abbott? Aggressive, too aggressive, not aggressive enough?
I live in California, so I might not be out of my house until December. So I like what they're doing out there.
I would say not aggressive enough.
Okay. Anybody else?
Say we all just got to be careful, do the right things. We've been working at our office since this thing's been shut down. We've been staying our social distancing and you just got to be careful.
Okay. So another question. You're talking about a price correction. What percentage are you guys looking at? 5, 10, 15, 20% price correction? And when do you think that'll be where we'll start to see some opportunities in that range?
Dallas, Texas, 5 to 10%. Houston, probably 15%. If you're going to wait over a year to 2 years, then you're probably going to miss out on an opportunity.
I'll agree with exactly that.
I agree.
Same here.
Okay. So no major price reductions, and you're looking at in DFW. Are there any submarkets in DFW where you think there might be opportunity, and then in other cities, obviously Houston because of oil prices, but any submarkets that you guys are focusing on where you think there might be more opportunities versus other submarkets?
I don't ever focus on the submarket, more the deal and what the structure of the deal is and the opportunity.
Yeah, that's a deal by deal.
Yeah, same here. We have some areas in DFW where we pretty much won't do deals in certain areas, but other than that, we're very deal focused and opportunistically focused on deal by deal, depending on where it's at.
Okay, so do you guys see oil prices having any effect in DFW?
No.
Not materially.
No.
When do we start seeing market rate transactions again in the DFW market? You know, we were seeing 30, 45 days ago. Values may be a little different, but those type of deals that we were seeing, when do you think the market opens up again?
July 12th. I think midsummer.
Go ahead, Mike.
No, I was just saying that probably after the second quarter.
I think one of the components, and James and Paul can jump on this, but it's going to depend on when agency, which is the primary lender, allows it to go. My understanding is it's going to be 90 days post state of emergency being lifted, and probably another 90 days for 3 good months of financials before they turn loose and not require the escrows that they're putting in right now. And the Fannie escrows would make, for most people, not possible to do a deal. So I would say the end of the year to the first quarter.
James, any feedback on that?
Yeah, I mean, that's dead on. I mean, right now, it's 12 months, P&I, taxes, insurance, replacement reserves. Freddie's 12 months. And then Freddie has that specific guideline. Fannie is, they're going to hold these reserves for 12 months. So I guess it's just going to depend when they feel comfortable shutting it off. But I mean, most people, yeah, it's going to be towards the end of the year before they release any type of interest reserve on Fannie and Freddie.
From my perspective, as soon as we can start to see an established track record of income coming in and the economy starting to go back to normal, you know, I think the financing piece is important, but also that can be factored into the deal, right? You can underwrite that in terms of an offer on a deal. So maybe before all that stuff goes away, maybe prices are artificially compressed a little bit more to kind of make it enticing for a buyer to do a deal with the 12 months of PITI and everything else. But I think the uncertainty piece is what stops me right now. I got to know that there's some sort of a light at the end of the tunnel for people to be able to have jobs and pay rent. I think that's when you'll see people start to actually want to buy deals.
Okay, another question. Are you guys issuing any distributions right now?
Yeah, that's what we talked about earlier. I think I'm the only one who is paying out distributions for this first quarter. But we're only paying out not the full distributions. We're paying out like half in a lot of cases. It depends on how long we've owned it, reserves. Everything that we talked about earlier factors into how much we distribute.
And then can I ask you, did you guys ever, does anybody do preferred returns these days, or have you guys done it in the past? And what type of a hole in the backyard are you going to dig for yourself if you did that?
Every one of our deals has a preferred return.
Sure. I mean, we've got preferred returns, and but it really doesn't matter. Okay, the investor has to come first, not the sponsor. That's another place where you're going to get into trouble. I think Mike said it earlier, talking about giving up fees on a property that doesn't work. We've done that. We've given up our construction fees. We've actually contributed before. The investor's got to be first, and if that puts us behind the ball, so be it. We're not going to do distributions for April. If May comes in good, we will probably look at making some of that up in July.
Yeah, on my side, you know, what I would say, Paul, is that we didn't do distributions. We pay out quarterly, once a quarter, so March and so forth. And what we try to do is with our investors are long-term holders. And we were very communicative about them, about the reasons why we weren't doing a distribution in Q1, which was really more proactive, because Q1 actually for us was quite fine profitability wise. We could have distributed just fine, but we really wanted to have that money in the bank so that we didn't have to do a cash call if the worst case happened in Q2. And so we were more concerned about not doing a distribution to be proactive about having extra cash in the bank than we were about the investors needing to get paid for Q1. And actually, to a T, I can't think of one single investor across our portfolio that said, hey, JC, you know what? You guys absolutely did the wrong thing. There was one investor that wished we would have distributed, but they also said, you know what? I really see where you're coming from. And I think we can appreciate this. And I think that if you're clear with investors about why you're doing things in this particular scenario with what we've got happening here, I think people are understanding.
Okay, another question. So you guys have been conservative on your LTVs and your reserves compared to most investors. Are you going to modify those downward now after seeing what has happened and go lower leverage and even higher reserves? And then what kind of effect will that have on your returns to your investors?
I'll start. So we're average 69, 70% debt before debt to capitalization. I think that'll stay roughly around the same because we're more storyline debt than agency debt. I do think the reserves or the willingness to distribute early, any way you want to phrase it, that will probably be a little more conservative than before.
Yeah, Charlie, we talked a little bit about this yesterday with your most recent deals and how you're going super low leverage, most likely on that. Do you think that's going to be a pattern moving forward, or is that just kind of a temporary, or maybe it's a Houston thing versus a DFW thing, just to be ultra cautious?
No, I'm looking at a DFW deal right now that I would be employing really low leverage for the first couple of years, just to kind of bulletproof the deal. Again, thinking long term, and that would be an opportunity to pick up a deal at something that I feel like that's worth doing. And so I think there's now the next 90 days to 120 days. And I think in the second half of the year, we're going to see some more opportunities from people that are going to find out that they've got issues that they are going to have to deal with. If somebody takes the forbearance, it's going to be the agency forbearance, it's going to be very hard on them because they couldn't make their debt service now. How are they going to make that up going forward? There could be opportunities for those in the second half of the year.
Okay, a lot of scientists are projecting that, this assuming that we don't have a vaccine, COVID-19 is going to come back during the cold winter months. And so is there anything you guys are doing to be proactive to prepare for that?
No.
Nothing's different than what we're doing now.
May.
I think it's just 2.0 of what we're doing now. All the
agreed.
tactics are in place.
Yeah.
Nobody has an in-house epidemiologist, is what I hear.
Dr. Fauci's coming to work for Price, really?
Dr. Fauci, wow.
Yeah, one more question, Bart, and then we'll call it a day.
Do you see spreads coming in? Do you see floors going lower? Do you see interest rates moving forward, going even lower than where they are right now? And when do you think Fannie and Freddie will ease up on escrowing principal and interest, taxes, insurance, reserves, and everything?
Bart, they're going to need data points before they start relaxing. I mean, and their floors have come in recently because there's no demand. So it really, with them, it really boils down to supply and demand of their loans, and then they're going to need data points before they start relaxing these escrows, in my opinion.
Anything?
No, I mean, I think even if Fannie and Freddie don't require it, it's probably a good idea for, like, going back to that broken deal example. These investors need 12 to maybe 18 months of reserves from their equity raise before they take on some of these deals. Because if the knife keeps falling, they're gonna need it there. So I think it's prudent, and probably not till the end of the year are we gonna see anything, as long as collections stabilize, unemployment stops going through the roof, and we see jobless claims slow down. And then I'm looking at positive GDP. When does we're going to have negative GDP for 2 quarters. I need 2 quarters consecutive of positive GDP before I think the consumer confidence comes back, and then your investor confidence will probably come back with it.
Yeah, great information. I think we've gone 60 minutes. So, Nick, I'm going to let you close it down.
Yeah, no. First of all, Charlie, Mike, Eric, JC, really appreciate you guys, and y'all are just a wealth of information. And I think it's really awesome that you guys are willing to share that with the folks that we had on this call today. So really sincerely grateful for that. For the folks that are listening, our goal is just to be a resource for you guys during this time. We are absolutely in no way, shape, or form using this as any sort of vacation. I mean, in fact, we're working harder now than we probably ever have. So, please let us know if there's something at Marcus and Millichap, that we can do to help, and certainly Old Capital as well. There's obviously a lot of questions in the air, but we will do our best to answer those questions. So with that, I really, really appreciate everyone's time today. And if you want to reach out to us, our contact info is on the screen. And again, thank you so much, panelists, for making time for us. And we look forward to brighter days ahead, sooner rather than later, hopefully.